In this unit, we will be looking at how to prepare the statement of cash flows. For limited company, you are required to know how to prepare several financial statements, including the statement of profit or loss, statement of financial position, statement of changes in equity, as well as this one, which is the statement of cash flows. The accounting standard that we will use here is IAS 7. Basically, the statement of cash flows analyzes the inflows and outflows of cash into our business. So it looks at how cash is generated through sources of income, through sale of non-current assets, through additional investment and finance into the business. And cash outflows take place because we have to make payment for expenses, buy assets, make investments, pay dividends, and take care of other finance costs. So a cash flow statement shows readers or the users on how cash is generated in the business and what is paid with that cash. Now here, IAS 7 has listed down the purpose of your cash flow statement. The first one is to assess current liquidity of a business. So liquidity is about cash flow. It's about how you manage cash coming in and going out. It, of course, provides additional information on business activities. If you remember, the statement of profit or loss tells you about profitability of the business. It tells you what the business has achieved in that period of time. However, statement of profit or loss is based on accruals basis. In other words, recognition of income when it is earned and expenses when it is incurred. So it doesn't consider cash flow. So statement of cash flows tells you what is your position with regards to the amount of money you have in your cash and bank. Of course, the statement of cash flows give you an overview of your major sources of inflows and outflows of cash. It can be used to help you estimate future cash flows. So if you can analyze the cash flows over a couple of years or over a few years, perhaps you can see a trend, and that can give you a better idea on how to budget for the future. And also, for most businesses, of course, you would wish that cash flows coming in or generated comes from trading, meaning doing business like selling goods or providing services. But it can't be helped that your cash inflows may come from other sources of finance as well. For instance, additional capital, taking up loans, and so on. Now, in the next slide, you would see this in your notes. This is a summary of how we break down or classify cash flows. We normally classify cash flows under 3 standard headings. Operations, so this is from the main trading activities of the business. You could be buying or selling goods. Perhaps you could be providing a service. Then, of course, the second group is investing activities, which looks at movement of non-current assets. So this is purchase and sales of non-current assets, including tangible ones like property, plant, equipment, intangible assets such as goodwill, patents, brands, trademarks. It also covers investment into other businesses. So all this is considered as investing activities. Financing activities looks at your major sources of finance for the business. So this includes non-current liabilities, which means borrowing money either from the bank, taking up a mortgage, perhaps issuing loan notes or debentures, and also additional investments from the owner of the business. So in the case of limited companies, this could be additional shares issued. Now, of course, under financing activity, you will have to pay for interest, pay dividends as returns to providers of finance. Now, we're going to look at each section one by one. This is a summary and this is available in your lecture notes, so you can look at it later. So I'm going to look at sectional slides. Moving on to the first sectional slide, let's look at operating activities, which is from your main sources of revenue and expenditure. So here, cash inflows under this section will of course come from the sale of goods and services. So if you are a supermarket, for example, this will be the sales of your products. But of course, you could be providing a service. So you may be a beauty salon, all right, or you're a college providing programs, educational programs. So collection from fees or from your clients. Now, it could also be from other incomes earned, such as rent received, commission received, and so on. Then, sources of outflows under this section: make payment to suppliers, so either for purchases or if you buy on credit, then it will be payment to your payables, paying your salaries and wages to the staff, paying for other expenses from rent to electricity to stationery. Now, you could, if you wish, include payment for interest on borrowings or loans, but I put an asterisk here because normally I prefer to put this under financing activity. However, IAS 7 is very flexible. They allow the student to put this either in this section or put it under financing activities. But my preferred choice, if I were preparing the statement of cash flows, would be to put payment on any sort of interest, loan interest, mortgage interest, debenture interest. I would prefer to put that under financing activities. Payment for taxes would also be under operating activities. Now make sure these are amounts paid and these are amounts received during the period itself. If you're selling on credit, for instance, and you haven't collected the money this year, it will not be in your cash inflows this year. Or perhaps, like in the case of expenses, perhaps you have used the expense, but you have yet to make payment for it in this period. It will not be in your outflows here. This has to be actual receipts of cash, actual payments of cash in the said period. That means during this accounting period. So you could be collecting from previous years or making payments for next year. It doesn't matter as long as the cash flow takes place during the period. So this is opposite of statement of profit or loss. Statement of profit or loss is different because you recognize the income and expense when it is earned and incurred, not when cash flows take place. In the next slide, we look at investing activities, which is a focus on the changes to our non-current assets. So here, cash inflows comes from the sale of non-current assets, the sale of investments. So for example, you may have shares or debentures in other businesses, and perhaps you want to sell them off, so money will come in. If you lend money to other businesses, perhaps they repay you, that is also money coming in. And you receive interest or dividends for your investment into other businesses. Now, again, I put a note here. If you wish, you can put this under operating activities, but I rather put it under investing since it is linked to our investments. Then we have cash outflows. So here, okay, This includes purchase of non-current assets, purchase of investments, that means making additional investments into shares and debentures of other entities, and also lending money to other entities. So this would be investing activities. In our final sectional slide, we're going to look at financing activities, which focuses on the changes to your non-current liabilities, which is primarily things like your loans, debentures, mortgages, and so on, as well as changes to your equities. Equities change when there is additional capital coming in. So in the case of limited company, this could happen because you issue shares. Of course, payment of dividends, payment of interest for loans would also come under this section. So these are examples of cash inflows, issue of shares, issue of loan notes, taking on new borrowings, and grants. These grants are basically funds that you get from the government. So perhaps you're in an industry where they're trying to promote or trying to kickstart. So you might get some funds to develop your product or to develop your service. Cash outflows, redemption of shares is under this section. A redemption or a share buyback happens when you take the shares back from the shareholder. That means you cancel the shares and you return their investment or their money back to them. In our syllabus at this stage, we will not be doing share redemption, but this is additional information for you. Now, you may pay dividends to your shareholders or equity holders. If it is a sole trader, cash drawings is also under this section. Redeeming debentures is similar to the last one, which is to pay back the lenders of loans. Redeeming debentures means that you cancel the debentures and return the money or pay back the money to the debenture holder. Now, here, to prepare our statement of cash flows, there are a number of two ways actually to do it. There are two layouts that we have to learn. One is called the direct method, and one is the indirect method. So I'm going to show you how to do that in the next slide. So this is the direct method. Now, notice we split our cash flows into three sections: operating, investing, financing. Now, of course, if you find this too small on the screen, you may look at the lecture notes. The full format is given there. All right. Now, here, cash flows from operating activities. We start with cash receipts from customers. This could include cash sales, receipts from receivables. This is a positive, so there's no bracket. Payment to suppliers for expenses for purchases, payment to your employees. This would be a negative, so I put a bracket. So this minus this would give you cash generated from operations. So make sure you learn the word. Payment of interest, you can leave it here if you want, or you can alternatively put it under financing activity, which is my preferred choice. But for CBE exams, the examiner will determine this for you, so you don't have to worry where to put it. Any taxes paid for the year should be included here, but be careful. We often pay our taxes late because we have to wait for the year to be over first before we make payment for our taxes. So if that's the case, be very careful. You may not be paying this year's tax. The tax paid here could be from previous years. You may need to do some adjustments. This will give you net cash used in operating activities. Then the next section is investing activities. So when you purchase non-current assets, notice it's a negative because money goes out. Of course, if you sell your non-current assets, the proceeds adds to your cash flow, so it's a positive. Purchase of investments, when you invest in shares and loan notes or debentures of other entities, obviously money goes out, so negative. If you sell off those investments, money come back in, positive. Any dividends or interest received where you see cash coming in is a positive as well. So this will give you net cash used in investing activities. These could be positive or negative depending on whether outflow or inflow is greater. Cash flows from financing activities. Of course, if you issue new shares or you bring in additional capital, if you issue debenture or long-term borrowings, meaning that you take on new loans or incur new debt, then it will be here. Redemption of preference shares, debentures, and loans. So this happens when you cancel these and return the money to the investor. Payment of dividend is also here. And if you don't put your interest paid in the operating activities, you could put it under financing. So these will be outflows. So here is net cash used in financing activity. Again, it could be positive or negative depending on whether inflows are more than outflows. Taking these three sections and adding them together, you could get a net increase in cash or a net decrease in cash. Now you will notice I use the word cash and cash equivalents. We also use this word in limited company. Basically, it's cash and bank balances. Now, the cash and cash equivalents at the beginning of the period, the brought forward amount, this is the opening cash and bank balances. Cash and cash equivalents at the end of the period, this is the closing cash and bank balances. So if your net change here, if you add it back to the opening balances, it should match what you see for your closing balances. Then you know you've gotten your calculation correct. So now we're going to look at a question using the direct method of preparing statement of cash flows. This is question 1 in your class exercise. Now, Bar Limited has the following financial statements as at 30th June. So here they have the cash at bank, the trade receivables, and the inventory. These are all your current assets. Sales equipment minus the accumulated depreciation. Land, buildings minus accumulated depreciation. These are your property, plant, equipment. In other words, your non-current assets. Of course, there will be changes here. You will notice changes between the 2 years. Now be careful, some exam questions, they would write the current year here and the previous year here. You have to just pay attention to what the question does. But here I've put the previous year and this is the current year. The second year is always the current year, the year that we're concerned with. So you will notice that there are some changes to the depreciation. Usually depreciation change because you're charging more depreciation. Notice the equipment has increased. So that tells you you probably bought new equipment. Land has come down though, which could indicate that you sold your land. No changes to your building. But at this point, I would say not to add or minus anything. Wait for the additional information. So our trade payables is listed here. Notice we have an overdraft here. We started with an overdraft, but we did end up with a positive bank balance. So I suppose there will be an increase in your cash. Share capital has increased, and usually share capital increases when you issue new shares. Now next, now if you look at the statement of profit or loss here, so you're given the sales minus cost of sales. You have to be careful when you prepare a statement of cash flows. These figures for the sales and the purchases, 112 and 180, you may not be able to use them immediately in the statement of cash flows because these could have credit sales and credit purchases. And your expenses here, you will notice they have non-cash expenses such as depreciation on assets, loss on disposal. When we do the statement of cash flows, what we're concerned with is actual payments for expenses, actual money coming in. So that means you're concerned with the cash flows itself. So you may want this other expenses in cash, but the rest you may want to leave them out. And for your sales and purchases, you will need to see the additional information to work out the receipts from your customers and the payment to your suppliers. Now, additional information, all purchases and sales of inventories are on credit. So this is very clear that we will have to use our receivable and payable control to find out our receipts from your receivable and payment to your payables. On 1st July 2007, the shareholders injected a further capital contribution of 12,000 cash into the business. So this is additional cash. So of course, this is issue of shares. This is financing activity. During the year, sales equipment costing 12,000 and written down to a carrying amount of 10,000 was sold for 4,000 cash. So what we are concerned with here is the cash proceeds because this affects our cash flow. Half of the land on hand at the beginning of the year was sold for 32,000 cash. That's why remember your land went from 80 to become 40 because half of it was sold. But what we want is the 32,000. This is proceeds from sale of asset. During the year, the company withdrew cash from the business bank account in order to pay the cash dividends of 12,000. So this is payment of dividends. Number 3 and number 4 affects investing activities because they are related to non-current assets. Number 2 and number 5, this is under financing activity because it has to do with equity, liabilities, or rather borrowing money, payment of dividends, injection of capital into the business. So now we're going to use the direct method to prepare our statement of cash flows. So let me show you how it looks like. Okay, first things first, I need the student to prepare the receivable control and the payable control. The opening balance is from 2008. The closing balance is from 2007. The sales is given to you in the SOPL. So your job is to find the one that is highlighted in green. This is the cash receipts from customers. Your payable account, opening payables is in the SOFP given from last year. Closing payables, of course, is from the current year, 2008. Purchases is from your SOPL. Work out the amount paid to your payables. Pause your video at this point and take this down. All right, assuming you've done that. Now, this is the statement of cash flows. So whatever you worked out in your receipts from your receivable and the payment to your payables, 108 and 174 is here. The 40 is the cash expenses paid that was mentioned in the SOPL. This minus this would give you cash generated from operations. For this question, we don't have income taxes paid, but if there is, you would put it here to give you net cash from operating activities. Now, to work out the purchase of the non-current assets, you will need to do this. You will notice, now I'm going to go back a few slides. So hang on. Take note of these numbers. All right. So here, there is no mention of purchase of equipment, but it doesn't mean they didn't have. Now notice they said that during the year, equipment costing 12,000 was sold, correct? So if I go back another slide, in the SOFP, notice my equipment, right? At the year end is 72. Last year it was 60. So 60, if I minus what I sold, it should be even less. But notice I get 72 here. So if I take 72 minus 60, and the 60 I also minus the amount that I sold, the equipment that I sold, that would give me equipment that I have bought. So you probably have to work this out yourself. For land, there's no new land. How do I know? Because they clearly mentioned half was sold. And you can see from 80, it became 40. Buildings, no change. So there is no purchase of new buildings. So here, moving to the slide with the answer. This is what I had in 2008 minus what I have left from 2007. So this is 2007's opening balance, but I minus out 12 because this is what I sold. Then I will be able to work out the purchase of my non-current asset. Notice it's a negative because it's obviously outflow. Money coming in from the sale of my equipment and my land, I added it up and it's a positive. So overall, I get positive inflow from investing activities. When I borrow money or when I issue new shares and so on, it goes into financing activities, right? So the proceed from the issue of shares, the 12,000 was mentioned. So that is a positive. Payment of dividends is a negative. So net change is 0. 26 plus 12 will give me 38. Compare it to the opening overdraft. This will be equal to the balance in my bank or cash in 2008. Now, I will stop the recording at this point. So you may want to pause it if you want to take these answers down, or you can always check the answers in the answer sheet or the answers given. Now here, in the next recording, I will be showing you a different method of preparing statement of cash flows. This method is actually the easier method and is also the method that is used in practice. It is the direct method. But the second method I'm going to teach you is the indirect method of preparing cash flows using profit as a starting point. And that method, although it's not as common in practice, as in like in real life, people prefer using the direct method, but that indirect method is popular with examiners. They like to use indirect method to test the student because it's a bit more challenging. So I'm going to stop the video here and you can move on to the next video once you understand this.